I'm going to explain more about the different investment options you may see inside your retirement account and also talk about proper diversification. I will start by saying you do not need to be an expert. There's no requirement on the level of understanding when it comes to your investments for you to still be successful with saving for retirement. Really lean on the experts though. So if you have an advisor on your 401k plan, whether it's my team or a different team, we're licensed. We're able to give you individual recommendation and advice. This is our job. So definitely ask questions and lean on us as the professionals. But becoming a smarter investor starts with understanding the language. So I'm going to walk through some just basic terminology and principles when it comes to investing. First, let's talk about different asset classes: cash, bonds, and stocks. And we'll start with stocks. So that's really a unit of ownership in a specific company. So publicly traded companies like Microsoft, Amazon, Apple, General Mills, 3M, Wells Fargo, they sell units of their stock. So you own a share of their company to outside investors. And there's different classifications with stocks. There's different sizes of stocks, different styles, so different objectives. There's different geographical locations. And the risk associated with owning a stock is the market fluctuation, and that is associated a lot with the actual performance of the company itself. And it could also just be market expectations. There's different ways to invest in stocks. You can open a self-directed brokerage account. There's different apps nowadays. You can invest in them inside individual retirement accounts. And in some plan-sponsored retirement accounts like a 401k or a 403b, you can invest in different company stocks. What's most common, though, inside retirement accounts through your employer, like a 401k or a 403b, are something called mutual funds. Mutual funds are investment options that pool together many different company stocks into one portfolio. Some mutual funds have 30 or 40 different stocks in their portfolio, and some have several hundred different stocks. This is a great way for people to invest inside a retirement account because they're very diversified. You don't have as much risk when you are investing in many stocks at one time versus just investing in one single company stock. And they're professionally managed. So there's different investment companies that have teams of analysts and managers that have a specific investment objective, and they're watching things and changing things, and they're going to the different companies and lifting the hood and doing their research on that particular company stock. So it's a great way to invest in many stocks at one time with lower risk. Here's just an example. Here's a sample investment lineup for a 401k plan. You can see there's about 15, 20 different investment options. These are mutual funds, and the name is across that left-hand side. You can see different names of investment managers: Vanguard, DFA, JP Morgan, T. Rowe Price, MFS. But the part that is circled, US Fund Large Value, this is the category, or in other words, the asset class that particular team is investing this mutual fund. So a US fund large value indicates to us that they are investing in US large value stocks. So if you were to lift the hood on this DFA mutual fund, it's investing in many different US based large value stocks. Another thing we look at is performance. Sure, we watch the short-term performance, like maybe year to date, the 3-month, the last 12 months, how has it done? But when it comes to saving for retirement and investing, really most of your emphasis should be placed on more of the longer-term performance. So I have circled there the 3, 5, and 10-year average performance of this particular fund: 4.68, 4.61, 9.79, and also in the gray, we are comparing your fund's performance to a benchmark or an index that's appropriate for that category. This particular DFA US large cap, it has many different stocks, like I said, inside of it. It has 368, in fact. And sometimes on these fund summaries, if you click on the investment, it'll not list out all 368 of them, but it'll show maybe the top 10 or top 15 stock holdings inside that portfolio. So this particular fund, it has 97% in US stocks, 1.6% in international. It has, like I said, 368 funds, and it's showing the top 10 holdings there in the middle of the page. ExxonMobil, JP Morgan, Pfizer. So companies that you've maybe heard of, right? Because they're large US company stocks. So we have a lot of name recognition here. And the percentage of the overall composition, since it has 368 funds, for a lot of them is very small. I mean, its top holding is 3.71% of the portfolio. Berkshire Hathaway is 1.96%, Comcast 1.86%, Walmart 1.77%. So if something bad happens temporarily or even permanent to one of these company stocks, if Walmart goes under, sure, that's going to affect your portfolio, but that was only 1.77% of this overall mutual fund portfolio. So when we talk about diversification, it's not putting all your eggs in one basket, it's spreading it out, right, among many different stocks. All right, now let's move on to bonds. Bonds are loans made to government entities or corporations, and the purpose here with bonds is to provide interest income to investors. And just like with stocks, there's different types. So there's different durations of bonds, short, medium, long. And the risks associated with bonds is interest rate fluctuations and credit risks. So as interest rates go up and down, or as your bond has different credit qualities, AAA, BB, C, that can affect the performance, the interest income that's provided to investors. We would consider bonds to be more conservative than stocks. And then next, cash. Cash is also considered conservative. The purpose is to preserve capital, seek steady returns, not a lot of fluctuation, and also provide interest income to investors. The risks here are inflation. So does the interest I'm earning on my cash or cash alternative fund, does it even outperform inflation, interest rate fluctuations, and also credit risks? So we have to control what we can control when it comes to investing. We're not able to control the market, but we are able to control how we personally are investing. And age and your own personal risk tolerance are two really important factors when it comes to your own investment strategy. Generally speaking, the further away you are from retirement, the more aggressive you're able to invest. Or in other words, the more you are able to have in higher risk stocks and mutual funds. You have the time on your side to make up short-term fluctuations and volatility. The closer you are to retirement, sure, you still want to have some risk, but not as high as when you are further away from retirement. You want to move towards lower risk types of investments. Risk tolerance, again, is in relation to your distance from retirement. So we have these different categories here: 20 or more years until retirement, 11 to 19, and then 10 or less. We also want to recognize that there are different attitudes or risk tolerances out there from individual to individual. I may be talking to somebody who is very aggressive. They are okay with more risk, more reward. They feel fine if they see volatility in the short term on their account, maybe more of a gambler by nature. So that would be the bottom row, right? When they're 20 or more years from retirement, they want to be aggressive. 11 to 19 years to retirement, moderately aggressive. 10 or less, moderate. But I could be talking to an individual that's on the top. They say, I'm really conservative. I don't like to see a lot of volatility on my account. It makes me nervous when the stock market goes down. I prefer slow, steady growth. I hate gambling. I never buy lottery tickets. I never do scratch offs. I just don't feel comfortable. Well, then with that particular person, we'd start at moderate, move to moderately conservative, and then conservative. So age is a factor as well as your own personal risk tolerance. Again, diversification, so spreading out your money among different types of investments, is important. This may help you offset market volatility and just overall manage the risk of your portfolio. So when you log in to your retirement account, you may see a pie chart similar to this, and it's telling you how much you have in these different asset classes like US large growth, US large value, international, etc. And here's what a diversified portfolio may look like over time. So the bond component, that light blue, sure, if somebody is retired or retiring pretty soon, that may be a larger portion of someone's account. But as your retirement date is extended out, you will see the conservative portion of the account, in this example, bonds, the light blue, that would be much less. So that's just a basic overview of different investment options, asset classes, and diversification. I wanted to let you know that we have a number of webinars coming up this year. So depending on when you're listening, but you can just scan this QR code and this will bring you to the registration page of our website. We have slated out a really nice agenda for 2024. And even if you can't join these webinars live the day of, still register because you'll get sent the recording. Thank you so much for listening. Please reach out to our team if you have any questions. Have a great day.